So by the end of today's episode, not just me, but everyone will have won an ESPY.
An ESPY? I don't know. Maybe, Matt. Are you on the list?
I mean, I should be. You've seen what kind of an athlete I am.
For what?
I'm a great athlete. I'm a great athlete. Hey, speaking of which, that's not all I do. I'm Matt Robeson, and I'm the host of 5-Minute Finance with our certified financial planner and all-around financial expert, Mike Morton. This is the show where we boil things down to practical steps you can actually get done so you can feel great about your money and lighten the load and stop worrying about stuff. Life is so busy. We got you. You have a quiz. I don't know. You slipped this over to me. I don't know if this is a quiz that I'm going to give you or you're going to give me. Who gets the quiz?
I get the quiz. You do the quiz.
Here's the quiz.
All right.
What's one of the best deals your company offers that your clients totally mess up?
Oh yeah. It's the ESPP, PP, Matt. ESPP.
It seems like an ESPY.
ESPP. Don't use it correctly, or you're not using it at all.
So they have the power to tell the future and know what other people are thinking, but they don't use it.
That's correct. Yeah, except with an extra P.
All right. Why do people? Wait. What's an ESPP exactly?
ESPP. All right. Today's episode. Here's what we're going to go over. ESPP. What is it? It's Employee Stock Purchase Plan.
Oh.
Employee Stock Purchase Plan. So we're going to go over what is it ESPP, how it works, the mechanics, risks and rewards of taking advantage of the ESPP, a case for selling and a case for holding the stock that you purchase. The purchase plan, Matt, PP, purchase plan.
Purchase plan.
Common mistakes, and finally, what should you do? I mean, we could skip to the end, but why not, tease it and you have to wait till the end to see what you should do.
And this is, I do want to get into the meat of the episode, but this is something that your clients truly do mess up often, or they need a little course correction.
It's a lot of people use them and use them correctly or use them, to their advantage. But I find some people just kind of breeze over them. I mean, it's one more thing, right? I'm now an employer at, NVIDIA. And, not only is it like, I got to figure out my ISOs and my NSOs and my RSUs and my salary and my job and my health benefit. I got to pick my healthcare plan and my dental plan and my vision. I'm going to go with family. Oh, and by the way, and there's this ESPP thing. You know what? By the time you get there, it's like, I'm done checking the box. I don't even know what this is. Moving on. So it can be a little overwhelming.
If all of that sounds appealing, and it certainly does to me, hold on till the end where we'll get to our listener question, which has to do with sweepstakes as best automatic sweeps. That seems like a useful
extra
one.
Cash.
Yeah, right. Exactly.
Always a good problem.
And hang on till the end for your one thing segment that is totally and completely off topic and super duper useful. I promise you, especially like the dudes of the household, this is how you look like a hero. Just take it from me.
Not just for dudes.
It's not just for dudes, but there's something about the psychology of dudes that makes this extra useful, extra helpful. You'll see what I mean when we get there. All right. Backing it up though for a second. So ESPP, you've kind of given us the overview, but like, what is this? Like, who does it apply to? What are we talking about?
Yeah, the Employee Stock Purchase Plan. So many employers, companies, will offer their stock to the employees, the workers of the company, for a discount or as part of a purchase plan, where you can set aside money from your paycheck to purchase the stock. So here's how it works. It's kind of what I just said. You decide how much you would like to purchase. There are limits. I want to say 15 to 20 grand a year. You can set it aside from your paycheck. You have to set it aside from your paycheck. So it's just like your 401k or your healthcare, it gets set aside. Hey, I'm going to do $300 a month. And the company then sets aside $300 a month. And then usually in these windows, which are typically every 6 months, they will purchase the stock for you and deposit it in an account. So at that point, you've got $1,800 and they will throw that, purchase the stock, and now you own stock. So you set aside money from your paycheck as an employee stock purchase plan, And that's how it works. Now, the real benefit though, Matt, is that you get a discount on the stock price. So it's like free money. And that's the reason that I'm shocked that more people don't sign up for the ESPP. So what happens is you start setting aside money on January 1st. And let's say you put aside some money and over 6 months. So you say maybe it's $100 a month. So you got $600. Then what they'll say is that they'll take the lesser of the stock price on either January 1st or June 1st, the start of the window and the end of the window. Okay. And they take the lesser of the price and then they'll discount that by 15%.
Wow.
Purchase the stock and deposit in your account. So let me give you some numbers. Say the stock was $100 on January 1st and it grows to 120. So that's a great increase, 20% increase in 6 months. That's fantastic to begin with. You get to buy it at $85. On June, when it's 120, you're purchasing at 85, 15% off the original 100, the lower of the two. So you buy it at 85, it's worth 120. You've already got a 40% gain if you sell it that day.
Wow. That is attractive. It sounds like the upside is free money. What's the catch here?
Yeah. There's not a lot of catches in terms of that portion of it. It is a 15% discount on the stock at either the start or the end. Now, say it went down. Okay. So say it went down, say the stock was 100 at the start and it goes down to $80. You get to buy it at 15% off of the $80 price and it gets deposited in your account. So you're getting a 15% discount on the stock price and you can sell it that same day and cash in on that free money.
Wow. And yeah. I assume that you still come out ahead even with capital gains.
You come out ahead because it's free money. So even if you have to pay tax on it, which you do, you do. Remember, the government's going to take their slice of any gain. But like I tell everybody, all my clients, I'll pay your taxes for you. You just give me your income.
Right. Wow. Well, that's very attractive. There's really not a catch here.
No, there's not really any catches in terms of if you were to do that strategy, what I just said. Hey, on the day it gets deposited, you set aside payroll deductions, for 6 months. It gets deposited. If on that day or the next day you sell that stock, if it's a public stock, which usually these are, you bought it at a 15% discount, you're going to pay ordinary income tax on that 15%. You were given like a 15% bonus. You set aside your own money. Okay, so you bought it with your own money, so there's no gain on that. But the 15% discount that you got, you're going to pay ordinary income tax on that 15%. So you end up with, 10% or whatever, a gain right away, free money.
So, all right. So is that's the case for that strategy? But you hinted there. I mean, you don't have to sell it immediately, right?
Yeah. So let's talk about the risks and reward, right?
Yeah.
The reward is what we just said, free money. It's great. And you can sell it that day and take advantage of that. The risk is that you are setting aside your money to purchase more of the stock of the company you work for. And I think we had an episode recently about this, kind of getting more risky. Hey, are you loading up on your employer stock? You're already getting RSUs, you've already got options, and now you're also buying more stock in the ESPP. See, the mental thing here, Matt, is that most people view this as an employee stock purchase plan. I'm purchasing stock. And that's where they stop. They just stop with step one. I've signed up for it and it gets deposited, and you're building up more and more over the years. You're building up more from your RSUs and your options, and now your ESPP, you're just owning more of your company's stock, and you're doubling your exposure because you're working for the company, you're still working for Amazon, and you own a lot of Amazon stock. And so if anything were to happen to that company, you might lose your job and the stock price might go down.
I see.
So that's the risk, is being careful about getting not too, over leveraged, in a single stock.
That was the upside on getting the stock.
Risk and reward. Yeah, that was how it works, right? So that's how the ESP works. Setting aside, you get the stock.
You're not going to be overexposed though if you just sell it immediately.
That's correct.
There might be a case for holding it though.
There might be, yeah. So the case for selling is kind of easy, right? Lock in that profit.
Right.
Hey, let's get
Free
that
money.
15% profit right away. It's kind of like the 401k match. Yeah. Hey, my company's going to match my first 4%. Put in 4%. It's like literally free money. If you sell it right away, you reduce that overexposure we just talked about. You're not kind of like adding it to the RSUs and options and other stuff that you might be getting. And of course, better diversification. You could take the cash now that you sold the stock for $5,000 and you could put it into a low cost index fund. That's the only free lunch in the investing world is diversification. And so those are the cases for selling.
I see. Can I ask you a dumbass question? Sometimes
of course,
dumbass questions are, it's my specialty. And also like, I don't know, they sometimes lead to interesting things. So let's say I work for, I don't know, what was your example earlier? NVIDIA. All right. Let's pretend two things. One, I work for NVIDIA. Two, I know what they do. Let's say that I'm relatively senior in the company and I have some useful information about, like let's say in your example, the look back is to January 1st. It's the end of the second quarter. It's June 30th. And there's about to be an earnings call. And I happen to have some inside information and I have this employee stock purchase plan. So would it not affect my decision about which strategy to use here, whether to immediately sell or maybe hold a little bit? Wouldn't my inside knowledge affect that decision? And is there any like rule about that? Like, isn't there such a thing as insider trading?
Yeah, it's called insider trading, Matt, and you go to jail. So don't do that. So here's what.
So how do I avoid this? Because like I'm getting this employee stock purchase plan because I'm an employee and because I have inside knowledge at the company. What do I do?
Spot. Well, don't go to jail. Okay.
So how do I avoid that, man? That's good advice, but
when you have inside information, so certain key employees within companies have inside information, and when you're in that position, you set up what's called a 10b5-1, which is automated. Just had an episode about automation. The 10b5-1 automates your selling because you're privy to inside information. There are only certain windows, times of year that you're allowed to set it up. And once you do, it goes for more than a year, typically about a year or so. And it says, I'm going to sell, and you put all kinds of parameters.
Got it.
If the stock price is this, or, I have ESPPs, or I have RSUs, or I want to exercise options, it's all in here, and you send it, and it just gets implemented. So now your insider information, right? You've automated your selling.
Got it.
At certain times ahead of you knowing the inside information.
You know what this puts me in mind of. So first of all, that's super practical and helpful. And second,
because you have inside information at your company.
I don't know. I mean, maybe if I do, I'm not aware of it. But watch prosecutors get me anyway. But it also puts me in mind of like all the insider trading laws that they've come up with for members of Congress recently. And like, they go to such pains back when that was my profession, like working for these folks, we would go to pains like, we'll put money in a blind trust and, et cetera. Yeah. It's like, well, the other thing you could do is you could automate a lot of this stuff. And then you don't have to worry about it.
Yeah. Automate it, set it up. You don't have to worry about it.
All right. So you covered, I think one slice of it, but I think you haven't made the case yet for you get this employee stock purchase plan. You might want to hold it, right?
Like, you might want to hold the stock, right? So you get it at this discount and you could hold on to it. One of the reasons you might want to do that, you get slightly favorable tax treatment if you hold on to it for at least a year. Now it's not huge, so it is a good thing, but you have to hold it from, if you sell it 2 years from when you were offered it and at least 1 year after the purchase date. So 2 years after you're eligible for that segment and 1 year, more importantly, 1 year after you purchase it. So you have to hold it for at least a whole year. Okay. And so if you have a stock that's somewhat volatile going up and down, you're just taking on that risk of that year. But if you do that, you get a little bit of favorable tax treatment. I don't find it anywhere worthwhile to outweigh the case for selling. But that is a case for holding, getting a little bit better tax treatment. You still have ordinary income on the 15% discount, but you get some long-term capital gains on the rest if it goes up.
Got it. Okay. All right.
Other reasons would be like, if you're bullish on the company, you think your company's going to do well, maybe the stock slid. Maybe you don't have quite insider information, but you still like, oh, I know some stuff's happening here. You're again, buyer beware. If you think you have insider information, ask your HR department. But many people know about the company, but aren't technically inside information people, key employees. So, if you're bullish on the company and think it's the stock has slid recently and it's going to go back up, you might want to hold. And then the final reason, Matt, as we talked about in the past, it's the get the only way to really get rich more quickly is to take on a lot of risk, which could, go sideways, right? Could not work. But that is a way, like if you were, again, let's take the NVIDIA example. If you've been holding on to all your ESPP for the last 5 years, you definitely would have been getting rich. Since it's gone up astronomically.
Right. And I mean, given everything I know about NVIDIA, I can only assume that is true given the things that they do. All right. What else do people need to know here about, like the pitfalls of ESPPs, like what people, like what they get wrong, what they need to optimize, think through a little bit better? Yeah,
totally. The first common mistakes, just not signing up for it. Like we just said, you get a free 15%. This is typical. Every plan's a little bit different, but typically it's a 15% discount. So sign up, get the free money. Yeah. In the United States, I was shocked by this, Matt. The participation rate for ESPPs is around 30%.
Wow.
Even though you have like that free money. So
free money.
Sign up. And then I would recommend selling it. So, set the reminders, calendar reminders. Hey, here's the couple times a year it drops into my account. Go ahead and sell it right away, reinvest it into, put it in your IRA. It could be your IRA contribution or, some other savings account or something. Treating it like a long-term investment. You can go either way as a mistake. This is a common mistake I see too, is like, hey, I don't really have the cash. Like I'm already saving in my 401k. I'm saving in my IRA. I'm saving in the 529s. Like I don't have any more, like I've got kids and they cost a lot of money. The ESPP doesn't have to be a long-term investment. You could just sell it every 6 months and take the cash and use the cash. You still get that 15% bump. And finally, don't forget that you will owe a little bit more in tax. So don't forget about the tax treatment.
Got it. Okay. Let's get to today's listener question. Reminder, clients of Mike, we want you to listen to the show, but you don't have to. In order to ask questions, you can just email Mike. But if you're not a client of Mike and you have a question you'd like to hear him address, pod@mortonfa.com. I hear that email is a highly reliable form of communication. Here is today's listener question. My brokerage account doesn't offer an automatic sweep into a money market fund. What should I do with extra cash? First of all, could you just explain terms here?
Chimney. The automatic sweep.
Boy, congratulations. If you got that cultural reference, you have been watching TV from 70 years ago. Chimney. Oh my gosh. Please, sir, I'm just a lowly chimney sweep. Yeah. So an automatic sweep. Oh, now you better explain it.
Yeah. All right. Yeah. So some brokerages, when you deposit $10,000 into the brokerage account, will put that into their sweep fund. And sometimes you'll choose that sweep fund, sometimes you won't. But the sweep fund is usually a money market fund. So therefore, if I deposit $10,000 into Fidelity brokerage account, it's automatically put into a money market account earning 4% interest. Okay, so that's great because then my $10,000 is getting 4% interest.
Right.
So it's automatically swept into a money market fund. Some brokerages don't do this. So Schwab and I believe E-Trade do not, when you deposit $10,000 into a Schwab or E-Trade brokerage account, maybe other ones, it sits in $10,000 of pure cash and they don't give you any interest, hardly any interest on that. Okay, it's one of the ways that they make money. They give you all kinds of free other stuff. I'm not against, they give you lots of free stuff. You can go Schwab, you get a free robo-advisor. It costs you nothing. It's great. Okay. But they have to make money somewhere. That's one of the ways that they make it. So what you want to do in those accounts is you want to get that 4% interest. So if you have cash, $10,000 that you should want to get 4% interest on that. That's current interest rates. So what you have to do is you're going to have to manually purchase a money market fund or a very short-term duration fund. So SGov, SHV, or SGOV, SHV, those are two different very short-term durations, which act very similar to money markets. There's also money market ETFs. Just be careful of the cost ratio, expense ratio. But that's what you want to do. For some of these, if it's not going to get automatically swept, you got to manually purchase something that gives you that 4% interest.
Wait, so can't I usually just automate that anything that goes into my brokerage account goes into a
fund?
Target date fund? Or
No, only if it's a mutual fund account, not your typical brokerage account. When you transfer $10,000, it is not set up to auto invest that $10,000.
Because that's the way mine's set up.
Yeah.
With Fidelity is, but that's part of what got me into trouble, right? Is that I thought like, it's all going into a target date fund. I wasn't getting it into my IRA. I wasn't getting it into my 5. So it's like I'm over in a tax, like too much in a taxable account.
Because it's automatically going into that mutual
automatically
mutual
going into a target date fund.
Yeah. So you can set them up that way, but this is for extra cash. And some of these places won't invest that cash for you without you doing it.
So you got to manually get it into a money market.
So, and this is just the point here overall is if you have extra cash sitting around in your checking, savings, brokerage account, hey, I've got 40,000 as my emergency fund. It's in my checking account, getting no interest, dude. Get 4% interest, put it in a high yield savings account, get it in a 6-month CD, get it in a money market fund in a brokerage, get 4%. That's like real money.
Yeah, why not? Free money. Let's get to our one thing segment today. Forget repair manuals. Forget even looking things up on Google. Don't do that. If you have a home repair question, or even one that you think you probably need to call a certified technician to repair for you, your first stop should be YouTube. Go to YouTube first. Just try it out. Just look up the serial number on whatever thing it is you need to fix and just enter it and just describe your problem. 90% of the time, there is some gal or guy out there who is like, actually, it's usually a guy who is like, let me show you how to fix your ice maker on your Maytag refrigerator. Stop making ice. This is probably your problem. And it usually works. And it usually is a much lower cost solution. And I will say that at the top of the episode, I may have intrubulated myself a little bit, seemingly, by saying this is really great for guys. And all the gals out there were like, hey, I do home repairs. The reason I said that is not that the gals don't do home repairs. It's the guys who like to pretend that they knew how to do it all along. And that's where YouTube is your secret superpower, because you'll look it up on YouTube and you'll come up with a solution and you'll be like, hey, honey, look what I did all by myself. So use YouTube for your home repairs. That's my tip.
Intrubulation. Yeah, you are getting intrubulation. Here's the thing about that. It reminds me that actually the women out there just really appreciate things way more than guys appreciate anything. So they appreciate stuff getting done, whereas guys are like, oh, you did that? Great.
Yeah. Well, and also they don't have the ego problem of like my wife would be fully like, yeah, I looked that up and I did it. And it was great. And I try to admit it when I use YouTube, but it's so tempting to just be like, because I was born with this gene that I knew how to fix the igniter in our stove. Oh my gosh. I've saved literally thousands of dollars in the last 2 years
save you.
By, just like figuring out like, oh, there's all these like aftermarket, like devices out there that you need to replace things with. And
it is shocking, like the amount of specific content now on YouTube, right? Like you were saying, you can put in your specific serial number, like the specific thing that's going on or the noise, like, and it's all there in video format now.
Right. And there's some, again, it's usually a dude who is trying to impress someone. It's like, look at how much I know. I'm not trying to diss these dudes because you've been so helpful to me, but like, it's usually a dude and they're like, yeah, this is pretty easy. and like, it's incredible. Once you've done this the first time, it's like you feel amazing. And you've saved hundreds and hundreds of dollars.
Save money, free money.
All right. On that delicious note, for Mike Morton, I'm Matt Robeson. We will see you next time.
Thanks, Matt. Thanks for joining us on Financial Life Planning. If you like what you heard, please subscribe to and rate the podcast on Apple iTunes or Spotify or wherever you get your podcasts. It makes a massive difference. If you have a comment or question, please email me, mike@mortonfa.com. Until next time, thanks for tuning in. This recording is for informational purposes only and should not be considered for investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. I cannot guarantee the accuracy or completeness of the data presented here.